Hello and welcome, ladies and gentlemen, to our 5th episode of Your Money Life Coach on eRadio with me, Barbara Mandel. This is your weekly Wednesday inspiration to act and manage your money better. Last week we looked at the various options for saving in 2021. This week I want to focus on investing. But before we dive right into it, people often ask, is there a difference between saving and investing? Yes, there is a difference. The key difference lies in the risk that you take when you invest. As discussed last week, savings options have very little to no risk, whereas investments, like we will discuss today, there are some risks involved. Investing is necessary to help your money work for you. The growth rate for investments is often higher when compared to the bank's savings rate, as you are taking risk. In this session, I'm briefly going to touch on asset classes. Investments will typically have cash, which is in your bank investments or money market instruments, bonds, which is not the bond on your property, but rather a company like Eskom or the government that requires capital. They will issue a bond. You will then invest your capital. Depending on the bond, they will pay you interest rates at certain intervals, for example 3 or 6 months. At the end of the period, you will get your full capital back. The most commonly known bond in South Africa is the RSA Retail Savings Bonds. We then have listed property, which is a fund that typically invested in properties such as office blocks and shopping centres. The growth on listed property comes from dividends, known as REIT or Real Estate Investment Trust dividends, as well as the change in the fund price. You then have shares, which we'll discuss in a moment. You can then also invest directly into commodities such as oil and gold, but it often requires more capital, is often more difficult, and comes at a higher risk and is less flexible in trade. To illustrate the value of investing, I'm going to use investing in company shares as an example. The return on your investment from shares is twofold. When you're investing in company shares, you become a shareholder. As a shareholder, you're entitled to dividends that the company declares. Dividends are thus your share of the profits that the company made. In some instances, the company will use the dividends to reinvest into the company, funding expansions and increasing the profit in the future. The second part of your return will be from the movements in the share price. There are many factors that can influence the share price. The most common one is supply and demand on the stock market, which is usually linked to news about the company's operations. A good example to use is when MTN received a fine in the Nigerian market, their share price dropped. However, when they appointed a new CEO that the market trusted, the share price rose. There are many economic effects that affect the share prices too, such as the exchange rate of the rand against other major currencies, the release of economic data, and the change in the interest rates, etc. The changes in the share price is also known as volatility. The bigger the spread is between the share's high and low prices, and the frequency of the highs and lows determines the volatility of a share price. Within volatility is where most of the growth lies. There's one thing I really want to emphasize, and that's the fact that you should never try to time the market. Even the best market prediction software has no higher success rates of 80% in predicting the highs and lows of the market. When investing, you should have a formally developed investment strategy and stick to it through the highs and the lows of the market. This will help you to avoid the panic selling in your portfolio and allow your money to work for you and your goals the way you intended it to. The longer you stay in the market, the more gains you'll receive. In the last 2 stock market crashes, 2008 and last year with COVID-19, markets have recovered to higher levels than before the crash within a 2-year period. Let's talk about diversification. Diversification is the use of different asset classes. You will thus have a bit of money in money markets, a bit in bonds, a bit of it in listed property, and some in shares. In certain instances, you'll make use of the same asset class, but your exposure to other countries known as an offshore component. This is important that you have the right mix of diversification to meet your objectives. The shorter your investment term, the less riskier asset you should have, such as bonds and cash. Where you have a longer term horizon, you'll typically have more equities and offshore exposure. Ensuring the right mix between the right asset classes for your needs and your goals and ensuring that your portfolio delivers inflation-beating returns, you need the skill of a professional. You can have a DIY approach. However, the role that a professional can play in your portfolio and helping you through the tough times of underperformance and market crashes remains invaluable. That's it for me today, ladies and gentlemen. Be sure to tune in next week Wednesday at 3 here on eRadio, where I'll be discussing tools to help you manage your debt in 2021. Feel free to follow me on Facebook, Your Money Life Coach, for more tips on how to manage your money better. You can also visit our website www.yourmoneylifecoach.co.za. If you found this episode valuable, you can also make use of the podcast facility on the eRadio website to share this information with your friends and family. I look forward to next week. I hope you do too. Catch us next week, Wednesday, 3 here on eRadio.